Imagine building a billion-dollar business from scratch. Like you survive the dot-com crash. You sail through the 2008 financial crisis.
Yeah, without a single down year.
Right, exactly. Without a single down year. You build this absolute fortress of wealth, and then at the height of your success, you voluntarily give away 80% of it.
It sounds completely backwards.
It does. It sounds insane. But today, we're tearing down the traditional sort of intuitive ideas of hoarding wealth. And we're looking at the actual counterintuitive mechanics of modern massive wealth. We're taking a deep dive into the real-world strategies for building, scaling, and most importantly, preserving a financial empire.
Yeah, and the mission here is to look past the superficial advice that you always hear. We want to extract the repeatable blueprints, the actual real numbers behind these major financial decisions.
The non-obvious stuff.
Exactly. Those non-obvious deal mechanics that founders and investors are using right now to scale and monetize. We are basically stripping away all the theory and just looking at the raw mechanics.
Right. And to do that, we have an incredibly revealing stack of sources today. On one side, we have a really detailed interview with Glenn Allman, who is a wealth manager handling $1.5 billion in assets. And he sits on a personal net worth of roughly $40 million.
Which is substantial.
Very. And then on the macro side, we are looking at a market analysis from Blockware that details capital rotation and the highly strategic mechanics of digital asset mining. Okay, let's unpack this by starting with Allman's blueprint for scaling, because his origin story is just pure, unfiltered grit.
Okay.
He leaves the Air Force at age 29 with about 200 grand to his name. And in 2002, he starts a wealth management firm from scratch. And when the source says from scratch, I mean, he was literally opening the local Ponte Vedra phone book and cold calling 200 people a day.
I mean, 200 calls a day just to generate enough friction to start a business, it's wild. And when you break down the math he provided, it's a staggering conversion funnel.
Yeah, walk me through that.
So out of those 200 daily calls, he would get maybe 10 people to actually stay on the line and just talk to him.
10 out of 200.
Yeah. And out of those 10 initial conversations, he would land exactly one client.
Wow.
So it is just a sheer volume play in the beginning. It's a masterclass in pushing through rejection just to establish a baseline of operating revenue.
And it clearly paid off. I mean, considering the firm today manages $1.5 billion. But I found a statistic in the source that is almost hard to believe. His frame has never contracted in 25 years.
Not once.
Not even during the brutal 2007 to 2009 financial crash.
Yeah.
They never had a down year in terms of business growth.
What's fascinating here is how the rules of wealth building profoundly change as a founder scales up. Because Allman initially owned 100% of his firm, which is, that is the traditional entrepreneurial dream.
Right. Total control, absolute ownership.
Exactly. But he realized that to truly scale into a billion-dollar entity, owning 100% was actually his biggest structural liability.
Wait, why?
Well, so he executed an equity recapitalization. He intentionally sold 80% of his equity to his partners, and he retained only about 20% for himself.
See, it's like a founder realizing that holding onto the steering wheel too tightly just basically guarantees the car will never go past 50 miles per hour.
Yes, perfectly said.
But I have to push back on the psychology of this a little bit.
Okay.
Because you cold called out of a literal phone book. You built the firm from dirt. You own the entire pie. Why would anyone willingly hand over the lion's share of their life's work?
Well, because you have to look at what giving up that equity actually buys you.
Okay.
This wasn't a loss. It wasn't some charity move. This is a highly calculated business strategy rooted in talent retention and succession. Like if you want to service ultra-high net worth individuals, you cannot be a solo practitioner.
Oh, because they want stability.
Right. These clients are handing over generational wealth. They demand absolute continuity. If you get hit by a bus tomorrow, those families need an absolute guarantee that they're still taken care of.
Oh, that makes sense. Actually, the source mentioned he adopted a framework from his Air Force days, ensuring every single client at his firm has 2 advisors, like a primary lead and a wingman.
Yeah, the wingman concept.
Okay.
So think about the mechanics of retaining that wingman. You cannot keep a top-tier financial professional around for decades just by paying them a salary.
Because they'll just leave.
Exactly. They will leave to build their own firm. You have to make some owners. So by diluting his own equity down to 20%, Allman essentially bought the loyalty and the exact professional talent required to grow the overall pie.
So the 20% of a massive pie is better than 100% of a small pie.
Right. 20% of a $1.5 billion unshakable fortress is infinitely more valuable and more secure than 100% of a fragile solo practice that just instantly goes to zero the second the founder retires.
Wow, yeah, that transition from building the business to actually living off the fruits of it is where the mechanics get really practical. I think we need to look at the personal monetization of that $40 million net worth. Like, how does a founder mechanically deploy that kind of capital to actually generate a lifestyle?
The real numbers from the source they're illuminating because they completely remove the mystery from extreme wealth.
Hmm.
Um, Allman spends between $30,000 and $40,000 a month to run his life.
Okay, so that equates to roughly $500,000 a year in just living expenses.
Yeah, and a significant portion of that includes operating a $1.2 million private plane,
Yeah.
a Cirrus,
Oh, yeah, the Cirrus.
which costs him about $40,000 to $50,000 a year just in baseline maintenance and operation.
Which, as an aside, that specific plane has a button on the ceiling that completely auto-lands the aircraft if the pilot passes out. Have you heard about this?
No, really.
Yeah, it's wild. It finds an airport, it talks to air traffic control, and literally lands itself. It's incredible technology. But anyway, when you look at how someone funds a $500K a year lifestyle, the immediate assumption is that they have this, massive, sprawling portfolio of commercial real estate quietly cash flowing in the background.
That's the cliche.
Yeah,
It-
exactly. Yet Allman is firmly, almost aggressively anti-real estate.
And his reasoning perfectly illustrates a concept that catches a lot of investors off guard, which is the hidden carrying costs of physical assets. So he keeps 90% of his liquid net worth in global equities, utilizing just simple, low-cost S&P 500 index funds.
Yeah, he shared a quote from one of his clients that real estate eats while you sleep,
Well, that's good.
which is such a good way to put it. And he lived that reality personally. The source notes he just had to write a check for $100,000 to replace his office driveway because of an underlying irrigation issue.
And that is the inescapable reality of physical dirt. It requires constant capital expenditure just to maintain its baseline value. Roofs leak, HVAC systems fail, property taxes constantly increase. Equities, on the other hand, do not ask you to fix their plumbing.
Right.
Allman breaks down the exact math for his strategy. If you deploy $10 million into a well-diversified equity portfolio, it will generate roughly $300,000 a year in pure dividend rent.
Wow.
And the mechanical beauty of that dividend yield is that it happens regardless of whether the broader stock market justice price goes up or down. It is passive yield without the physical friction.
No late-night phone calls about a broken water heater from a tenant.
Exactly.
But here's where it gets really interesting. Let's look at Allman's actual product. He is a wealth manager, but he isn't sitting at a desk, picking individual tech stocks all day. The core of his entire business model revolves around these 11 by 17 graphical documents he builds for clients called life maps.
Yeah, the life.
When you strip away all the finance jargon, it seems like his true product isn't investment returns at all. His product is basically convincing anxious rich people that it is finally safe to spend their money.
It is an entirely psychological deliverable. Like, think of the target demographic here. You have people who spent 40 years aggressively saving every single penny, terrified of running out of money.
Right, hoarding it.
Yeah. Now they have $20 million in the bank, they're in their 70s, and they're still flying in middle seats complaining about a bad back.
Right, his pitch is literally, if you don't spend this money and fly first class to take care of your health, your kids are going to fly first class when you're dead.
It's brutal.
It is brutal, but I imagine it's highly effective. Is giving people psychological permission to enjoy their wealth the actual moat of his entire $1.5 billion business.
So it is the ultimate moat. And I'd say an essential blueprint for any modern service provider. Think about it. Raw financial data is a commodity now. Anyone with a smartphone can buy an S&P 500 index fund for zero fees. But providing clarity and emotional relief, that commands infinitely higher loyalty.
Because it's personal.
Exactly.
Yeah.
When you visually map out someone's entire life and mathematically account for their deepest fears of going broke, and then you objectively prove they can afford to charter a flight for their health, you transcend being a portfolio manager. You become indispensable.
Wow.
That psychological permission structure is exactly why his firm never loses clients.
So Ullman built his wealth by eliminating the physical friction of real estate,
Yeah.
avoiding the broken driveways and the maintenance, and focusing on pure digital yield from equities. Which raises the question, if eliminating physical friction is the ultimate wealth cheat code, how does that apply to manufacturing assets natively on the internet?
Well, that's a great transition.
Because that brings us to the Blockware source, which introduces a modern, highly contrasting blueprint, basically leveraging digital asset mining as a corporate tax and acquisition strategy.
This raises an important question. Why is this heavily utilized by institutional miners, but totally overlooked by traditional investors?
Right.
This is a prime example of a non-obvious deal mechanic. The average retail investor views Bitcoin simply as a volatile asset you buy on an exchange and hold, hoping the price eventually goes up.
Just speculation, basically.
Right. But the business strategy detailed in the source is fundamentally different. It is about the mechanics of producing the asset yourself.
The actual manufacturing process.
Yeah.
So the source walks through a scenario where a business owner, someone generating high active income, like maybe a surgeon, a partner at a law firm, or a successful founder, purchases $100,000 worth of Bitcoin miners. And because these miners are technically classified as equipment, they can use tax depreciation to offset $100,000 of their active income in a single tax year.
Exactly.
I want to make sure I understand the mechanics of this, though. How does buying a computer wipe out your tax liability?
It operates under the exact same tax codes as buying heavy machinery in agriculture or manufacturing. Like normally, if you buy equipment for a business, the IRS makes you spread that deduction out over several years.
Right, standard depreciation.
But under certain provisions, like bonus depreciation or Section 179, you can take the entire deduction up front.
Oh, wow.
So if that hiring surgeon buys $100,000 in computing hardware, they can instantly wipe $100,000 off their taxable income for that current year.
That is massive.
It is. But the real magic of this mechanic is in the production numbers. By owning and operating the machines, the investor can effectively produce Bitcoin at a cost of roughly $45,000 per coin. Meanwhile, the spot market, priced like what you would pay on a public exchange, is trading around $80,000, with projections pushing toward $100,000.
Okay, let me put an analogy to this. It's like buying a factory that prints a highly sought-after physical commodity. You get to write off the entire cost of building the factory on your current year's taxes, saving you massive amounts of cash up front.
And then the factory produces the commodity for you at basically half off the retail price.
That is exactly what's happening. And traditional investors get blinded by the asset's day-to-day price volatility, so they fail to see the mechanism. This is a calculated, tax-efficient corporate cash flow play.
Right, they just see a chart going up and down.
Yeah. The real aha moment here is the shift from viewing Bitcoin as a speculative lottery ticket to viewing it as a tax-advantaged manufacturing operation. You aren't day trading a coin, you are industrializing a tax deduction. The yield just happens to be paid out in digital assets instead of dollars.
I was looking at the Blockware data, and I'm trying to wrap my head around the macro environment that makes a strategy like this so viable right now. Like, the source points to a massive structural collision between supply and demand. We've got this fixed supply of digital assets, but the government is engaging in what the source calls yield curve control.
Yes.
How do these two forces mechanically interact? So to understand the collision, we have to look at the money supply. On one side, you have a mathematically finite supply of 21 million Bitcoin. It is capped forever in the code.
Right.
On the other side, you have fiat currency. When the source talks about the M2 money supply sitting at all-time highs, they are referring to the total amount of physical cash, checking deposits, and easily convertible money just floating around the global economy.
And yield curve control is the lever that keeps expanding that M2 supply, right?
Yeah.
Because the Treasury has to manage $40 trillion in government debt.
Exactly. Let's break down that specific mechanic. If interest rates on that $40 trillion debt are allowed to spike naturally, the interest payments alone would essentially bankrupt the government's balance sheet.
Oh, yeah, they couldn't afford it.
So the central bank steps in to artificially cap those rates. They do this by purchasing their own government bonds. But to buy those bonds, they have to create new money out of thin air.
Right. Quantitative easing, basically.
Yes. They literally flood the financial system with cash to keep borrowing costs low, which continuously expands that M2 money supply.
Which means all that newly created cash is aggressively looking for a place to go.
If we connect this to the bigger picture, capital does not behave like a predictable ocean tide that gently rolls in and out. Capital behaves like water under high pressure in a closed pipe.
Okay.
If you squeeze the traditional markets, like if you have high interest rates, punishing standard borrowing, and massive carrying costs, punishing commercial real estate, that liquidity doesn't just disappear. It aggressively seeks out the nearest crack.
It looks for the path of least resistance?
Yes, with the highest yield. Right now, there is massive liquidity looking to take profits from the booming AI equities that have driven the stock market recently.
But because of that water pressure, that profit has to be deployed somewhere else.
Exactly.
And it's not going into commercial real estate because we just covered Alman's $100,000 driveway and the brutal reality of physical capex. And it's certainly not rotating into long duration bonds if the government is manipulating the yield.
Exactly the opposite.
Yeah.
That high-pressure capital is looking for an asset that trades with tech-like upside, but possesses a completely finite supply that cannot be diluted by central banks. And so that capital is forcefully rotating into digital assets.
So what does this all mean for the actual investor trying to time this rotation? The source brings up this concept of the 4-year cycle that a lot of people in the digital asset space obsess over, tying market tops and bottoms to the halving of the asset's issuance rate. But then the source actively pushes back on it. It basically argues you can't just trade by a calendar.
Because trading by a calendar is a fundamental misunderstanding of how markets actually work.
Right.
Markets do not care what month it is. They react to marginal changes in global liquidity and supply. So the source emphasizes a completely different philosophy, which they call buying the whole bottom.
Meaning you don't just sit on a pile of cash waiting for a magical Tuesday in November to deploy everything just because a chart told you to.
Right. The non-obvious lesson here connects right back to Ullman's cold calling grind from earlier. It is about consistent operating income.
Okay.
If you're generating strong cash flow from a business, you do not need to perfectly snipe the absolute bottom of a market. You manufacture the asset at a 50% discount today. You manufacture it at a 40% discount tomorrow. Successful scaling requires the continuous mechanical deployment of capital into assets over time, rather than paralyzing yourself trying to guess an arbitrary timing cycle.
It really all comes back to cash flow and the mechanics of friction. Whether we are looking at Ullman deliberately diluting his equity down to 20% to lock in the talent needed to build a $1.5 billion fortress, or his strategy of completely ignoring physical real estate to pull $300,000 of stress-free dividend rent from global equities.
Or a high-income earner utilizing equipment depreciation to manufacture digital assets at a massive discount to the spot price. These are completely distinct blueprints operating in different asset classes, but they share the exact same underlying foundation.
Yeah, they all require you to understand your true value, moat-like providing psychological permission to anxious clients. They require you to ruthlessly measure the hidden carrying costs of your assets. And they require you to actively utilize tax structures and business mechanics to your advantage rather than just buying and hoping.
Well said.
These are repeatable lessons that apply to building wealth at absolutely any scale.
It is about engineering the financial outcome, step by step, rather than just participating in the market and hoping for the best.
Which leaves us with a pretty heavy concept to chew on as we wrap up. We've seen how capital is rapidly rotating right now. We've seen the raw math of investors avoiding the massive carrying costs and the physical friction of traditional assets. So if fiat currency supplies continue to expand under the weight of national debt, and holding physical property continues to bleed cash through relentless maintenance, irrigation issues, and taxes, digital assets and global equities eventually entirely replace physical real estate as the bedrock collateral for generational wealth.
It's a mechanic that challenges thousands of years of financial tradition, but the math is certainly pointing in that direction.
It really is something to mull over as you look at your own blueprints and the hidden carrying costs in your own portfolio. That's all for today's deep dive. We'll catch you on the next one.